Historically, when it comes to investment, we Indians have been risk averse. That is, we avoid taking too much risk with our money. So over the years, we have been investing in real estate, gold, FD, PPF and insurance. But every investment has its pros and cons. For example, real estate in the past has rewarded the investors handsomely. However, the real estate prices are now so high that a normal investor can't even think of buying a property. Moreover, the real estate prices have been stagnant for a long time now. And when it comes to liquidity, the liquidity is low with real estate. It means when you need money and you want to sell the property, it would be difficult to find the buyers. There are also other issues like fraud, land mafia, disputes, etc. If you talk about gold, most of the people like to purchase physical gold and keep it in the locker. Again, gold has its pros and cons. For example, it has high liquidity where you can sell it anytime. The returns have been decent over the years. But then there are issues like high making charges, risk of theft, risk of purity, etc. If you talk about FD, the rates have gone down drastically. Today, a FD with a reputed bank is available only at 5 to 6% interest. And if you fall under 30% tax bracket, then your effective return from FD post-tax would be merely 3.5% to 4.2%. Insurance has been a bad investment and I have already explained it in my previous videos. You should never mix insurance and investment. The major issue is high commission charges, low transparency, poor liquidity, which means you can't sell your insurance when you need money, and lower returns. That leaves us with one more option: investment in the Indian economy. Hi, my name is Sahil and this is my Personal Finance Academy where I explain money management in layman's language. In this video, I am going to analyze the historical performance of Indian stock market over the period of last 30-40 years. And then we will decide whether it is a good idea to invest in the Indian economy or not. The chart you see on the screen is Sensex Journey from 1986 till 2020. If you quickly observe, Sensex was at the level of 561 in 1986 and currently it is at the level of 36,000 in July 2020. That's 64 times return in 34 years. If you observe, the market has been quite volatile during this entire period. Let's analyze the key events in the history and see how it has impacted the Sensex. From 1986 to 1990, Sensex has moved from 561 to 780, giving an average annual return of 9% in the 4 years. But then something happened. Sensex zoomed from the level of 780 to 4,163 in just 2 years. That was the era of Harshad Mehta. He was a big name in the world of Indian stock market. He manipulated the market and it eventually rose 4 times before it started falling when the scam was exposed. In just 1 year, Sensex fell almost 50% from level of 4,163 to 2,100. But then eventually market recovered and it moved from the level of 2,100 to 4,600 in the next 1.5 years. However, the next few years were sloppy. The market did not perform well for the next 4 years. Then we saw the dot-com boom. Internet was the new sensation and every dot-com company was trading at high valuation. It made the market overvalued. In no time, market rose from level of 2,783 to 5,933. But then the dot-com bubble went burst. Market fell from level of 5,933 to 2,950 in the next 3 years. But then we saw one of the best phase of growth in the Indian economy. Market zoomed from the level of 2,950 to level of 10,000 in just 3 years. This rally was even fueled due to housing market bubble in the US. In no time, market moved from the level of 10,000 to level of 20,000. But then the US housing bubble went burst and the world economy collapsed. Market fell from level of 20,000 to level of 8,000 in just 1.5 years. But again market recovered. Sensex moved from level of 8,000 to level of 20,000 in the next 1.5 years. But again Sensex declined 25%. In the next 3 years, Sensex almost doubled from the level of 15,000 to level of 30,000. Market was in the growth phase where Sensex moved from level of 23,000 in February 2016 to the level of 42,000 in January 2020. But again, market collapsed almost 40% from level of 42,000 to level of 26,000 in just 2 months due to COVID-19. But recovery was also quick. Within 2 months, Sensex moved from the level of 26,000 to the level of 36,000. So what are some of the key takeaways? In the short term, market is very volatile. It can fall as high as 60% during the worst phase. But every time the market falls, it recovers. In the long term, Sensex has zoomed from the level of 561 in 1986 to current level of 36,000 in 2020, giving a return of 64 times. If we consider the peak of 42,000 in January 2020, Sensex has given an annual return of 13.45% over the past 36 years. Do you know if you had invested rupees 10,000 in 1986, what would be the value of your investment? Rupees 10,000 invested in 1986 would have become 7.3 lakh by January 2020. During these 36 years, FD has given an annual return of 8%. It means the same 10,000 kept in FD in 1986 would have given a return of 1.36 lakh by 2020. It means Sensex has given 5 times return than FD. And if you look at the current FD rates, they are in the range of 5 to 6%. The inflation is around 5%. And if you fall under 20 to 30% tax bracket, then your effective return is just 3 to 4%. So your effective return from FD is lower than the inflation rate. In the past 36 years, we have seen many catastrophes. We have been in war with Pakistan and China. We have seen some big financial meltdowns. We have seen thousands of corruption cases. Yet our economy has not just survived, but it has flourished. So it definitely makes sense to invest in the Indian economy. If we talk about the future of Indian economy, COVID-19 has certainly created a big dent in the economy. The market might fall in the short term. However, one thing is for sure, it will eventually rise. India is one of the fastest growing economy and one of the youngest workforce in the world. We are a country of 1.3 billion people. Just imagine the amount of internal consumption in the country. The salaries are rising, the spendings are rising, and everyone is focusing on Indian economy. Personally, I have no doubt about the growth of India Inc. But there is a big question. How to invest in Indian economy? How to pick the right stock? What is the right price to buy this stock and right price to sell this stock? What if the company fails? For example, we have seen cases of Jet Airways, Reliance Communication, Yes Bank, etc. What if the stock price is manipulative or it is a bubble? How to know if the management of the company is competent and honest to run it for the long term? How much time to invest for research before picking the right stock? Can an average retail investor with a job or a business keep a track of stock market to manage all the investment? If it is about investing 2-3 lakh, then you can still invest in stock market. But what if you have a corpus of 50 lakh to invest? Can you still invest such a huge sum in the stock market? There is a solution to all this problem. That's where mutual fund comes into picture. Mutual funds have got experts who invest your money in the Indian economy. They do charge a fee for that. This fee is expense ratio. For a normal retail investor who do not have the time to invest for the research or do not have the right knowledge to pick the quality stock or want to avoid the volatility of the stock market, mutual funds are the best solution. However, mutual funds are like a deep ocean. There are many categories within mutual fund, and there are many schemes within each category. So the biggest question is how to pick a right mutual fund, how to build a right mutual fund portfolio. I'm going to explain every concept of mutual fund in the future. In the next video, I'm going to reveal a shocking fact about mutual fund which every investor should know. If you make that mistake, you will lose lakhs of rupees. And if you avoid that mistake, you will save a lot. If you need personalized help, you can reach out to me. The details are mentioned in the description box.